Hey everybody, welcome back to Taking Trades. Happy Saturday to you. Today we're going to get into options. I thought what a perfect opportunity. Take a Saturday, let's talk options. I want to start today off by talking about covered calls. And I want you to jump in the comments real quick and just tell me if you've ever heard of a covered call, and if you have, tell me of your experience. Tell me how you've traded them, how have you used them, and have you traded one recently? So with that, let's dive in. Okay, here's the reason why I love selling covered calls. A covered call is basically owning shares of a stock and then selling a per share premium, or almost like a rent per share just to hold the stock. Now, I think it's easier just to jump on the whiteboard and kind of draw it out a little bit for you, but basically if you have shares of stock and you've already had them, this is a great strategy because those shares of stock that you hold are likely just going to sit there and hopefully appreciate, but they aren't making you any extra money if, say, they don't move up. Maybe they just stay within a range. What if Facebook traded 200 to 195 to 200 to 195 and didn't really go anywhere? Well, in the case of the covered call, you would actually be making money every time you sell a contract on these shares because you get paid sort of a rent or a premium per share. Let's jump to the whiteboard, and I want to give you a visual example so you understand what I'm talking about. Break this down and make it a very simple example, but let's say real quick, I'm just going to draw out a couple specifics here. Let's say you have 100 shares, and let's call it of, let's just stick with Facebook. So we'll go ticker FB, and let's say you have 100 shares of Facebook, and then let's draw a tick right here, and let's say that Facebook is currently trading at, let's say, $50 per share. So you've got Facebook 100 shares at $50, okay? Now, what a covered call is I can say, I don't think that Facebook is going to go above a certain dollar amount within a certain given amount of time. So let's say for this example, I don't think Facebook is going to go above, let's say, $55. So let's draw a little tick right here. And let's say this is $55 right here. I don't think Facebook is going to go above $55. And let's pick out a time frame. Let's say maybe 1 month. So 1 month is going to be what is known as our expiration date. And I will show this to you later on the options chain, but 100 shares of Facebook, we're going to pick a 1 month expiration date. And this dollar amount that we don't think it's going to go higher than, that dollar amount is called your strike price, okay? So the strike price is the price you choose, and the stock needs to actually stay below that price. Now, what's interesting about the covered call is when you own the stock and you write a covered call, it's actually considered a bearish strategy because you want the stock to stay the same, stay below $55, or just go lower in general. You want it to do anything except go above $55. So if this is our $55 line right here, and we track this out a ways, and let's say that your stock is at 50, and it comes up and down, and it's moving around, and it's not really doing anything, and it gets to here and pulls back, and then at 1 month, it's right here. What that means is that this contract you wrote expires worthless, and you just keep the premium that you got paid at the very beginning. And I'm going to show you an example of premium, where that comes from. But on the other hand, if this were to go and move around and go above $55, and after 1 month you get the expiration date and it expires above $55, what that means is you lose your 100 shares. Those shares will be purchased from you at $55. Some other party that you wrote this contract with, they have the right but not the obligation to purchase these shares from you at $55. Now here's the upside. Your shares were at 50, they went up $5 to the strike price that you chose, and then it expired above, so you lost them. So you still made $5 per share,
in addition to the premium you got paid. So for example, let's say in this contract you got paid, let's just say $1 of premium, okay? So that means that for your 1 month expiration on your Facebook stock, you bought 100 shares. You got paid a premium of $1. So that means that you ultimately got paid $100 of premium. And the minute you get paid that, you can't lose it. It's yours forever. So $1 per share times 100, $100. Now the other thing to understand is that in the stock options world, one contract, okay, if you write up a contract, that one contract has to be 100 shares. That's the smallest increment you can get into. So if anyone says, I sold 2 contracts of whatever, you know exactly what they're talking about. Because if they sold 3 contracts, you know they're talking 300 shares. Because one contract is 100 shares. Now, that's also a problem sometimes because if you're trading, say, a large price stock like Google or Amazon, 100 shares is very capital intensive. So there's definitely a sweet spot in options for finding the right price stock because you have to buy 100 shares, but then also looking to get the right amount of premium per share. So just a quick review before I'd show you the options chain in the TD Ameritrade Thinkorswim platform. Your stock was trading at $50 and you entered a contract and said, within 1 month, I don't want Facebook to go above $55, which is your strike price. So a strike of 55, an expiration date of 1 month. So within 1 month, it only gets to here, 54.50 we'll say. Then the contract expires worthless. You keep the premium like always, and then nothing happens. It expires, you move on, you could set it up and do it again if you want. Now, if it does go above 55 and expire, then your shares get what they call called away. They get bought from you. Someone can buy them at $55. Even if it's at $70, they can buy it from you at $55. So that's a limitation to the strategy, is that if a stock goes to $100 and your strike was at 50 to 55, you're only going to get paid at 55. That's where someone will buy them from you. They could then turn right around and sell them at 95 or whatever level they are currently at. But if you think that the stock is just going to kind of meander around or move around a little bit and you don't think it's going to take off and go to the moon, this is a great way to get paid a little extra money to hold your position. Now, on the options chain that I'm going to show you, there is a way to get paid premium, but also keep the likelihood very low that your shares are going to get called away. Because one question you might be asking me is, well, I don't want my shares to be called away. I want to get paid, but I also want to keep my shares. I want to keep them, for the next 10 years. I don't want to lose them. Well, let me show you how that works. Let's jump into the TD Ameritrade Thinkorswim platform. Okay, let's dive into this. So I brought up ticker SQ, which is Square. It's trading around $67.75. And let's use this as our example, and I want to show you how you would possibly enter one of these trades. And if you owned a lot of Square stock and you didn't want to lose it, let's talk about how to approach that scenario as well. So the stock's trading at $67.75, and what I'm going to do is I'm going to open up the options chain real quick. So what you want to do is go to this trade tab right over here, click that, and that's going to go ahead and bring up, and actually let me move, I'm going to come up here for a minute. All right, so what you can see here is this is the options chain. And it's really handy. It shows you all the available options contracts. And with options, they always expire on Fridays. But which Friday depends on what you select. So you just know that Friday is an expiration date. It's always a Friday. So let's look around and let's say, okay, we want to set up an options contract. Let's set one up for 34 days, okay? So let's go to the chart and let's say in the next 34 days, I don't think that Square stock is going to go above, let's say for example, we just think, I don't think it's going to go above $70. Let's say that you think it's going to get rejected at this level and it's going to head back down, okay? So I'm just going to draw a quick line on here just to make it easy. So let's say right here at $70, let's call this, there's our $70 line. So we think it's going to stay below 70. And we have a suspicion that, you know what, within the next 30 days, I think it's going to come up here, drop back below, and then start to curl back up, and we want it to expire right in here. So if we go ahead and we head over to the options chain, let's go to trade, and then we've got the options chain. So let's say within 34 days, we don't think it's going to go above 70. And we own 100 shares of Square. So here's 34 days. We click this and open it up. And what this is going to show us is all the different options we have for this particular contract. So here's the $70 strike. So here's the important part. We've got 34 days as our expiration date, December 19th, and we've got $70 here as our strike price. So if we owned 100 shares and we want to write the covered call, we come over here to the call side. Last week in a video I talked about the put side, but we're going to stay on the call side right now. And this $70 right here, you can see that you have a bid and an ask, just like when you're trading stock. So we try to get something in between the bid and the ask. So right now, it's $1.82 and $1.86. So if I want to go ahead and I want to sell this covered call, what I do is I'm going to come in here and I'm going to right click and click sell, and then what I want to sell is just a single, and that will bring up this window, and I only own 100 shares. So here's your quiz. How many contracts would that be? 1, right? So what I'm going to do is I'm going to move this down to 1. So I've got 1 contract of Square, and I'm talking about it expiring on December 27th. Sorry, I said the 19th earlier. December 27th of 2019. Here's our strike. You can see that right here. That's 70. And $1.82 is where I want to get paid for my premium. Now, what I like to do is on this board right here, I like to go to the mid price, which is right here. And this little bar will put you automatically in the mid price. So we said $1.82 was the bid and $1.86 is the ask. So I want to go somewhere in the middle. So let's go $1.84. And then what happens is I click confirm and send, and it brings up and it's going to show me exactly what I've got going on. So it tells me that right away the max profit I can make on this trade is $184. So that's the immediate amount that I can get paid of premium that goes right into my cash, right into my account, and it's mine forever. I can't lose it. Now, the downside is that once you have this in play, you get paid the premium. So if it goes above your strike, you could lose the shares. But then the other side is the stock could always go down. So that you could lose value in the stock as it goes to the downside. That's another risk you have. But for this scenario, we're going to say $70, $1.84. So we made $184 to hold this stock. And as long as it stays below $70 until the expiration, it'll just expire. Now, if it goes above and expires above 70, what happens? We lose our shares. Somebody can buy them from us, and they'll buy them from us at the strike of 70. Now, what's nice about this in the options chain is you can go ahead and set up whatever you want. You can experiment and look at the different dates. You could go out 55 days, and you could say, I don't think it's going to go above 75. You could say, oh, I don't think it's going to go above 70 within the next 55 days. So you've now changed it from 34 days to 55, and look at the difference in the premium. Now you're talking $2 and roughly 82 cents. So $2.82 times 100 shares pays you $282 immediate cash to wait and see what's going to happen, to see if you're going to get called away or if the contract is going to expire worthless. So those are the two options. Now, one thing to think about on here, when you're looking at the options chain, you can sort of think of this delta level. This delta level, and I'm going to go back to the one that we were looking at here, 34 days. Think of the delta, and what's nice is Thinkorswim also puts this probability out of the money right here. So the delta corresponds with probability out of the money. This is the percent chance that your contract is going to expire worthless. So it's very, very helpful. And what a lot of people will do is, if you don't want to lose your shares and you want to have a very low probability of being called away, you want to keep the chances of keeping the shares, you want that to be very high. What you want to do is pick a strike that is way, way, way out of the money. So for example, you might choose this one down here, 85% chance that it won't breach your strike price. Now you get paid a lot less, but the thing is, if you have 100 shares that aren't doing anything other than appreciating, if you make any money, that's a positive thing. So you could look at 85% and say, okay, I'm going to make 60 to 65, so let's call it 62 cents. You could get paid $62 to hold these 100 shares and have a very good probability that you're not going to get called away because you're so far what they call out of the money. This is in the money, the yellow, because the strike price is $67.50. This is in the money, but anything above the current price of the stock is called out of the money. And if you go to 85% out of the money, there's really only about a 15%, 18% chance that it's going to cross your strike. Now, if you come closer and you do 70, you say, okay, my strike is 70. Well, now there's only a 64% chance that it's not going to breach your strike and get called away. So it's a much greater chance down here than if you were to be up here at the 85. Or go even further, 94% chance that you're not going to get called away. You make much less. Now you're making $23 instead of $62 or instead of $1.84 like we talked about earlier. So you can just basically take and stretch things out as far as you want. And if you go with an 80 strike, we can look at that on the chart over here. So now the 80 strike is way up here. So as long as in the next month your stock doesn't go above this level, you could get paid that, I think it was $23. So $23, it's a small amount, but it's still $23 for doing nothing other than just waiting and watching this stock. And if it happens to go that high and go above $80, you're going to get paid the difference between here and $80. So you're going to make a bunch of profit, plus you got to keep the premium. So it's kind of a win-win in that scenario. Now again, some people say, well, the downside is, what if it goes to 100? You don't get any credit from 80 to 100 because your strike price was at 80.
So I wanted to keep things simple in today's video on options and the covered call. If you have questions, list them below. I want to hear them. I want to answer them. I want to engage a little bit. This was kind of an experiment for the channel to see if you guys like this kind of content. If you do, thumbs up, subscribe if you're new to the channel, and if you didn't like it, let me know that as well. I want to hear all your questions and comments. So happy Saturday to everybody, and we'll see you next time.